Okay, well, greetings everyone who is taking investment and portfolio analysis. I would just like to take this opportunity to answer a few more questions that were asked recently. I promise I'll get back to you. Now, let me start with this one regarding the difference between closed-end funds and ETFs. Um, For the definition on the slides, they look quite similar. This student is very kind enough to actually include the slides in question. I'm sorry if it looks a little bit small, but basically it looks as though closed-end funds do not differ from ETFs because they both trade in stock exchange, and there can be some deviation from the net asset value, which is how much the fund is in fact truly worth. There can be some deviations, although there are more deviations for closed-end funds. Now, the difference is as follows. For First of all, whether it's closed-end or open-end, in the end is no more than just an operational detail. That both closed-end and open-end funds, they are funds that are set up by fund managers, fund management companies like Fidelity, Templeton, AXA, State Street, those guys. Okay, so these are professional managers, so they set up the funds, and if they will keep taking new money or are happy to let you redeem, if they want to surrender their investments and ask for their money back. So that would be an open-ended fund. And a closed-end fund is when they have raised $1 billion, and there are 100,000 investors, and they all have shares, and it's really up to the investors to sell shares to each other. So once I get my money, I just focus on managing it. As for the ownership, it's really up to the investors to trade amongst themselves. That's a closed-end fund. Now, you might get confused between closed-end funds and ETFs. The difference is very simple. Okay, closed-end funds are set up by fund management companies to pool together a large amounts of capital so that professional investment managers can apply their judgment and actively manage the portfolios. Okay, so they would pick stocks, they would do asset allocation, they would look at the risks and optimize Sharpe ratio and all that stuff, manage the tracking error, the whole load. Okay, so the emphasis really is on the management of the fund, and the fact that as it is shown here, the fact that it trades in the stock market. If you can't read this, you have to go back to your notes. The fact that it trades in the stock market is, for me, nothing more than just a minor operational or legal detail, if you like. That's the platform where you can buy or sell closed-end funds. They will not be terribly liquid, and because the funds have assets that are chosen by fund managers, you don't always know just exactly what's in there, which is why it's not as transparent. So there's more room for the trading price to deviate um, from the actual NAV, the true value, if you like. Okay, either too more expensive or cheaper. Okay, so the closed-end fund is just think of Fidelity, Templeton. They are operated by asset managers. There's a guy behind who is actively looking at it. Now, ETFs also trade in the stock market. It is true, um, but they trade far closer to stocks. They look like stocks. They trade like stocks, which is to say, there is a lot more liquidity. The bid offer is a lot tighter, and they are far more open and transparent. So ETFs are very frequently rule-based, such as the value partner that I introduced you to. But a lot of them are not even that complicated. They are just simply based on indices like the S&P 500, or some kind of emerging market index. The FTSE Sinhua A50 that you can trade out of Singapore is a good example. That is not managed actively by anybody. It's just a basket of 50 stocks. That's it. Okay. So there's the difference. So ETFs are intended to be simple, and open and transparent and cheap, and kind of almost like autopilot. Okay. Whereas closed-end funds, or even open-ended funds, okay, both of them, they have managers behind, and closed-end funds will trade in the stock market. But like I said, that is nothing more than just a legal detail. Okay, so that's on question 1. Now the second question. So it might be easier for you to read like this. Oh, maybe not. This is easier to read. Okay, so I got, this person has 2 questions regarding the tutorial assignments. So first in chapter 4, question 13b, the question asks, what is the rate of return of an investor who held these securities as the fund manager did? Under the situation, I think the investor did not invest in a fund. You are correct. Instead, he, why does it say it's a he? Can be a she. Okay. Let's find out later. Managed the securities by himself. However, when calculating the rate of return, why should we add back the income and capital gain distributed by the fund, 150? Because if this person was to manage the investment at home, DIY, do it yourself, what has the fund's $1.50 distribution got to do with it? That's the question. Okay, it's a good question. Okay, so let's get out of here. Let's just have a look at the actual question, which is here, I think. Okay, so this was the question. Okay, so you just take a moment to read the question carefully. Okay, it's part B. Now, the interpretation of this question is as follows. So here you have a fund starting with a net asset value of $12. At the end of the year, the NAV is $12.10. Now, just for a moment, ignore the second sentence about the premium and discount. So this $12 means at the start of the year, if you take all the assets and if you really put them under the sun, they are worth $12 per share. And At the end of the year, if you were to do the same, they are now worth $12.10. That's the true fair value, true market value. Okay, now this premium stuff, 2% at the start and 7% discount at the end, is the deviation arising from investors not always truly knowing how much the assets are really worth precisely. Okay, um, and this $1.50, I know it says here the fund paid a year-end distribution of 150. The way to interpret this, okay, forget about the premium and the discount for a moment, okay. The way to interpret this is as follows. So your assets are truly worth $12 at the beginning, and your assets are truly worth $12.10. And what's more, during the year, your assets, which started with a value of $12, has earned you income and capital gains of $1.50. So the simplest way to look at it is, if you really want, okay, is that I start, if I'm the manager, I started with $12, and in fact, by the end of the year, if you and then during the year, I would be buying and selling some shares, buying and selling, and for the shares that I was holding, there would be some income, dividends, okay, but I'm also buying and selling and presumably making profit. So at the end of the year, I have what? I still have some stocks, okay, and I have cash from the dividend income and also the buying and selling of those stocks, the realized gains, in other words, okay, and the whole thing comes to $13.60, if you like, which is $12.10 plus 150. So this 150, you have to look at it that way, okay. Although this is to do with the fund, if you just forget about the premium, forget about the discount, these are just distractions, okay. What really happened to the fund? Suppose the fund was so generous and so precisely valued that these discounts and premiums never existed. So basically $12 has now become $13.60, okay, of which you have accumulated $1.50 of gain. So therefore, if you were the home investor, this is exactly what you would have achieved. Okay, you turn $12 into $13.60, of which 150 is actually cash gain from realized capital gains, and all of that you would just give out to the customer. Okay, so if you look at the answer, it's purely the performance would be the rise in NAV. Now it looks like it hasn't gone up a lot, but that's really beside the point. But what you have are $1.50 of dividends, and also capital gains, capital appreciation. Okay, I hope I have explained it in an understandable way. Okay, so all I'm saying is you turn $12 into $13.60, even if you were doing it at home, okay, and you are copying exactly what the fund is doing. Okay, what is the fund doing? The fund is doing this. The fund starts with $12 and gets some income. We don't know how much, maybe 80 cents, and it trades in and out. buy sell in our long short, and it gets another 70 cents of realized capital gains, okay, and then with the stocks that it's still holding at the end of the year, those stocks are worth $12.10. Okay, that's how you can try to understand that. Now, there's another one here. So, second question. In Chapter 11, Question 25, as we already know, there would be three factors affecting Ford's price. Why do we still use the two-factor model and exclude the factor for new car model? Which model is the two-factor based on, CAPM or APT? Well, because there's more than one factor, I would answer your last question first. It's definitely based on the APT, not the CAPM. Now, which question was that? It was actually this question here. Suppose that during a week, the Fed announces a new monetary policy and Congress passed legislation restricting imports of foreign automobiles. It's funny. Do you guys remember we did this problem way before the presidential election, and I was kind of joking with some of you that it may well happen, depending on who won the election. Now we know who won the election, and I wonder if that guy will do this. He keeps threatening to. Okay. Now the answer, as you remember, is that we what we can do is we try to gather together the historical returns for Ford in the past. Okay, so let's say we first look at the returns before all the announcements took place. Okay, and we assume that the return of Ford is driven by the market return, and then the industry factors. Okay, so the market return will be influenced by interest rates, and then the import on the restriction on imports will impact the sensitivity specific to that industry. Okay, and then you get these parameters. So and then you also need an alpha term in there. Okay, now if before the announcement Ford was just a good old-fashioned boring car making company, then before the announcement, okay, this formula should really be sufficient to characterize the return components of Ford, with alpha being probably quite close to zero. Okay, so good old-fashioned boring old Ford is driven by the market and the industry. Now, what they claim now is that they have come up with a new model, and they think that it would increase profit. Now, let's suppose that was not true. Okay, so even after the announcement, Ford is still driven by good old-fashioned market risk and industry risk, just as before. Okay, then if it really was, if the new model was completely irrelevant, okay, then you would find that when you do this regression, okay, you don't really get much significant alpha happening. The thing to think about is if this equation, okay, if you are measuring forced return, let's say prior to the announcement, then there really shouldn't be any alpha, okay. But after the announcement, now you try to determine is there actually something else at play here, okay. So you try to now investigate this relationship, and if the new model is just not relevant at all, if it makes absolutely no difference, then this alpha, this little alpha here, wouldn't be very significant. However, if the new model really is making Ford an outstanding company and making a major contribution, then it cannot be captured by the market return or even the industry return. That's the whole point. Okay, so when you want to investigate whether some factor X, okay, really makes difference or not, so the first thing is you isolate, you ignore, or you look at what happens before that factor was in place, and then before that factor was there. Okay, so when it was not there, what happened? And then if the appearance of that factor made no difference at all, then the before and after uh, comparison, okay, should tell you that okay, that factor has not made any impact whatsoever. Okay, so that's the logic behind it. Okay, now let me turn to the next one, which is question 3. Now this refers to I think a question that was mentioned. This refers to a passage in Bodhi, which was also probably mentioned in class, and I think the passage is okay. Let me try and find it. I think it's this one here. Okay, so this person was asking, why does it say that? Okay, so look at this graph, okay, and look at what I've highlighted. So when the distribution is positively skewed, so here in this graph, there are 3 distributions. First of all, there's the normal distribution, which is the gray line here. Okay, now the gray line is being sandwiched by the blue line and the black line. And on the left hand side, the blue line is when there is a negative skew, okay, and the black line is when there's a positive skew, okay. And it says here, when distribution is positively skewed to the right, the standard deviation overestimates risk, and conversely, now if you read on, you're going to be totally confused by what they're saying, because extreme positive surprises nevertheless increase the estimate of volatility. Some people just don't have a clue what they're trying to say. Let me try and reinterpret this for you. I think you can read from here, when the distribution is positively skewed, the standard deviation overestimate risk. Okay, stop right there, and then come down to this line here. When the distribution is negatively skewed, the standard deviation will underestimate risk. Okay, so take note of these 2 sentences and just ignore what's in between. And I'm going to try and explain to you. Now, the thing is, when you are analyzing a whole load of data, let's say return data. So you have 3,000 observations, and so in Excel, it's very easy for you to take the mean and then the standard deviation. Now the problem is when you do that, you take the what we call the first and the second moment. Just by looking at them, you do not know whether there is any skew or not in the data unless you actually analyze it deeper by looking at the what we call the third moment. So here's the idea. Okay, suppose let's take the first sentence here. When a distribution is positively skewed, the standard deviation overestimates risk. Now, what does that mean? First of all, the idea of risk here, okay, I think we are referring mostly about to downside losses, okay. So imagine you have a set of data which looks like the black line, okay, so it's positively skewed, but you think it's normal, okay, or you made a mistake or you made a wrong assumption and you think that it's actually normally distributed. So if you look at the two graphs, that means you expect that there is a lot more downside because the gray line, okay, goes all the way out. It's projecting that on the negative side it could reach minus 40% with at least some probability, whereas really minus 30% is already quite extreme with the actual data set that you have, which is the black line. Okay. Now, on the other hand, if your data set is negatively skewed, which is represented by the blue line, okay, but you mistakenly think it is normal, okay, so you think okay, the worst that it gets, would likely be somewhere around, let's say 45%, okay, which is this point here, whereas actually it can get a lot worse. Okay, so you by making assumption based on the normal distribution, when this thing is actually skewed negatively, okay, it's actually a lot riskier than you think. So you have underestimated how bad things can get, in other words. Okay, so that's why I am interpreting the first line of this paragraph and the last line, and I just ignore the bit in between. I think it's not well written. Okay, sorry, Professor Bodhi. Now, question 4. I thought I don't clearly understand what is time diversification. Professor Fong told us in the lecture, according to the textbook, risk does not fade across time. But I just remember Professor Fong mentioned that time diversification is still possible. I want to know what is the logic behind. Okay, let me. I can split the answer into two parts. The first part is the theory, and then the second part is I share with you some sort of empirical observations. Okay, so what is the theory? Now, if you read, okay, now first of all, what is diversification? Never mind time diversification. Okay, what is diversification? Diversification is hold on a second. Let me hang on. Okay, I think the best way for me to show you this is to go back a bit to some of the tutorial notes that I made. By the way, I'm gonna digitize all these scribblings that I made, and I'm gonna make it available to everyone. Now, you might remember round about tutorial 5 when we started talking about diversification. If you had $100 and you can invest in two assets, A and B. Okay, so let's say and let's just say they have the same expected return. Okay, but they are not completely correlated, or they are poorly correlated, or maybe even negatively correlated. So diversification means in such a scenario, it is always beneficial to invest some portion of your money in A and some of it in B. Now, why is that? Why is that? The reason is simply that as long as they are not perfectly correlated, then you can get the same return, okay, but your risk is lower. Okay, and I think by now you all know, or I hope you do, the reason why. Okay, it's all to do with this formula here about portfolio variance, which we even talked about this week or today with tutorials 3 and 4. Okay, so diversification is when somehow magically you are able to maintain the same return, but somehow you cut risks. Okay, now that seems beautiful thing to happen, and that's diversification. Now, what is this thing about time diversification? Okay, the idea is as follows. So if you have some money and you invest in a risky asset, and you have a choice where you can invest for 1 year or 2 years. Okay, so either you invest in the risky asset for 1 year, and then you invest in the risk-free asset for the second year, or you invest in the risky asset for 2 years. So the logic is, if you invest in the risky asset for 2 years, then assuming that the return of year 1 and the return of year 2 are not correlated, not perfectly anyway, not correlated, then surely you get the same return, okay, but your risk is reduced. Okay, so that's the idea. Okay, now this idea may work when you split your cash into two assets. So you have $100. Instead of investing $100 in A, you invest some in A and then you invest some in B. And as long as they are not perfectly correlated, it absolutely works. Okay, simultaneously. Now, if you actually have like a sort of two-step approach, and you try to think of it in a similar way, it doesn't actually work exactly, and the reason is you can actually look at where was it? I was looking at it just a moment ago. Okay. The text I would like to refer to is actually on page 230 of Bodhi edition 10. When they start talking about now time diversification, is quite a subtle. It's like an offshoot of what we've been talking about. If you go to the end of this section where they present three possible scenarios, so you are going to invest your wealth for 2 periods. So for in the first choice, you invest for in the risky asset for the first period, and then in the risk-free asset in the second period. Okay, and then in the second case, you invest your money in the risky asset in the first period and the second period. Okay, and they are trying to show you that the diversification in this context is not the same as the time diversification in this context is not the same as the diversification I just told you a few minutes ago, which was magically preserve you can preserve the same return, but your risk is somehow smaller. Okay, here for choice number 2, relative to choice number 1, what happens is your return is higher, but your risk is also higher if you choose to invest for a longer horizon in the risky asset. Okay, the thing is, your return is rising faster than your risk is rising, because you take the square root for the standard deviation. Okay, but in any case, the key point here is both are rising. Okay, so end up your Sharpe ratio improves. Okay, which is good, but time diversification in this manner is not really the same as the time is not the same as the diversification in the sort of Markowitz risk return trade-off, not and the you know portfolio being optimized because you maintain your return but your risk goes down. So it's not the same ball game at all. Okay, that's what they're trying to say here. So in the end, therefore, as a result, they argue that time diversification is not really diversification and not in the classical portfolio management framework that I was telling you at the earlier part of answering this question. Okay, because your risk and returns are moving in a different manner. They did say actually that if we look here at choice number 3, which is when you invest half of the money in the risky asset for period 1 and period 2, and you place half of the funds in a risk-free asset for also period 1 and period 2, then what you do is you can maintain the same return, but your risk goes down. Okay, now, but this is not what people call time diversification. Okay, now in any case, I don't want to go too deep into this. The reason people say time diversification does not work is that choice number 2 ends up having an impact on your return and on your risk in a somewhat different way than what we are used to discussing here. Maintain the return and keep and lower the risk is the name of the game here. That isn't really happening here. Okay, so they argue that time diversification is not really true diversification. Now, that's the theory, and I hope so far you understand what I'm on about. Okay. Um, in practice, why do we think that sometimes, after all, if you say that time diversification has benefit, what does that mean? It just means that if you hold a portfolio of risky investments, um, you end up helping yourself if you simply hold it for a longer period. In the end, that's what that means. Okay, um, do not hold it for a short time. Hold it for a longer time, um, in order to reduce your risk. Okay, now that's the practice. Now I already talked a lot about the theory, um, and why the return goes up, but the risk also goes up. So it's not really the simple stuff that we've been talking about here. Um, in reality, okay, what happens is, the question is, the question that then is simply, okay, I have some money, I have $1 million, and if I want to commit that to the stock market, shall I really do it for 1 year or 2 years or 5 years? Okay, and people argue that, if you think there is such a thing as time diversification, well, no, your return multiplies, but your risk also goes up, even if it goes up slowly, which is not what we are talking about here. Okay, now in reality, though, why do people still cling on to this idea? Now I'll show you a graph, and I think you will appreciate it. Now this is actually the historical return of the U.S. market. I think it's the S&P 500. Now it goes back a long way. I'm sorry you can't read it. It's from 1992 all the way to this year. So that is a 24-year history. Okay, long before some of you were even born. Okay, so these numbers at the bottom here. These are years. Okay, now you look at a graph like this, and let's say uh, um, you invested here around this period. Okay, which was so this is year 2000. This is when the stock market started to crash because of the internet bubble. So let's say you invested here, okay, and suppose you are a fortune teller and you have perfect foresight, okay, or even with the benefit of hindsight, you ask yourself, if I invested here, okay, um, should I actually invest for, let's say, from here to here, which is what, like 2 years, okay, or shall I invest from here to here, which would be like a 4-year period, or shall I invest from here to all the way here? Okay, now with the benefit of hindsight, I think the answer is obvious. Okay, if you have the staying power just to sit it out, eventually it seems that there's some kind of cyclical pattern to the market and it does actually recover. Okay, now that is why, despite the all that theory that I just showed you and I try so hard to explain, okay, people still think that investing in the long term actually has some wisdom in it. Okay, because when you look at a 24-year history, nothing can beat that. No amount of theory can argue with what you actually see out there in the market. Okay, so if you invested here, okay, which was 2008, right at the height of the global, stock frenzy, and then it went all the way down. Okay, and then if you only just invest in for let's say a year or a year and a half, that would be a complete disaster for you. Okay, but if you actually held on, okay, over, I don't know, 6-8 years, you'll be all right again, and you might even be by now you'll be laughing. Okay, even if you invested in the peak there, it's actually it's gone way beyond that previous peak. Okay, so despite the fact that if you hold risky assets over time, it increases your expected return, but it also increases your risk. So therefore, it's not really diversification in the classical sense. Okay, despite that observation, okay, it seems that in practice there is still some value in holding stocks for the long term. Okay, I think that's what Professor Fong was trying to say to you guys. Okay, now while I'm here, I might just share with you something that I'd never managed to say in the tutorial. Now you can see the slide, the header. It says the temptation of trading U.S. stock market since 1992. Now, what do I mean by that? Now I'm on a completely different topic. Okay, um, I think there are people who say that, oh, you should just not only uh, hold a portfolio passively. Okay, you should hold it passively for a long term, and no one can beat the market and so on. Now I'm on a different topic. Okay, so you should hold a portfolio passively and perhaps do it in the long run, and then because it's so hard to beat the market. Now if you look carefully at this chart, between the time of 1998 to the time of this little dotted red line, the time of 2011, okay, for 13 years, you could argue that if you had invested here and it's gone up, down, up, down, up, and down, okay, so for 13 years, you made absolutely nothing, more or less, okay? Now, why do I call this chart the temptation of trading? When a fund manager or when a trader sees a chart like that in retrospect, there is a real temptation to say, wow, what a waste of time, me just holding a portfolio, and then for 13 years it just goes for a walk and it comes back and it doesn't do anything. How about if I try to buy here, sell here, buy here, sell here, and buy here, and sell here? Now I know, of course, it's very, very hard, okay, but when you look at a chart like this, you can't help wondering, well, isn't it better at least to try than to just invest your money thinking that it could well do absolutely nothing for well over a decade? Okay, that's what I mean by the temptation of trading. It will always be there, because people will always think that way. Okay, so I hope this is helpful, and I have answered 4 very interesting and thought-provoking questions, and I hope I did so in a satisfactory manner. And if anything is unclear, feel free to let me know. I thank the people who wrote to me. And I hope I've answered the questions properly. Thank you very much.